This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me again this morning Charles Hugh Smith, well-recognized writer on the web, who is the publisher of the website of2minds.com. And welcome back, Charles.
Thank you for having me back, Gordon.
You brought some great slides on marginal return. I thought I would front-end it because what it really resonated with me is a series of papers that I put out that ties it together of why we're seeing marginal returns. And the reason we're seeing it is because we have the degree of mispricing and malinvestment that's now in our market, and not just the United States, but around the world. And it's a sequence, and it's a natural sequence. And what it does is when you start to have misinformation, as we've seen, as we try with whether it's gross domestic product or the inflation rate or CPI, and we've talked about these things in the back, and a bit of a deception, things start, what you get is you get moral hazard. And right now we're seeing moral hazard and unintended consequences coming out of monetary policy, not just the Federal Reserve, but globally. And with it, it leads to deceptions, and it's based on deceptions and distortions. And I'm not talking about things that are illegal, just that the line starts to get a little complicated, if you would. What happens is you get misinformation that leads to manipulation. Both of those are, you get into a line of ethics. Then you get into malpractice. And malpractice is bad practice, bad techniques. We just seen it, for example, with J.P. Morgan and the big whale. And some of it's right over the line with PFF Best. What happens is they're making decisions and practices in their company to try and accommodate these new unintended consequences and the issues associated with moral hazard. This leads across the line. Now you get into malfeasance, and you get into then when you don't understand where the baseline is, mispricing and malinvestment. So there's this combination of a shift in our morals along with bad monetary practices. And that's what we have. I refer to it as monetary malpractice. And what happens is money has lost its value. It's no longer a store of value. And this is all part of a roadmap that I believe is leading to a fiat currency collapse. Not necessarily a total economic collapse, but the use of fiat currencies. And we're going to have to base those in the future on a stronger basis. And I have a particular chart here, just to finish my thought here, Charles, that shows how these are connected. These aren't just words that I'm using in concepts. These are actual developments that we're seeing, that I'm laying out here, that are unfolding within our markets. And whether it's competitive devaluation, low yields, the financial repression that goes with these kinds of things to force people into taking on more risk in the markets because yields are negative, all starts to feed on itself. And that's why on a lot of the points that you're making, and I think in your work, reflects the fact that we have marginal returns. It's malinvestment, what it is. Sorry to be long-winded, but comments on what I just said, Charles?
I think those are two brilliant charts, Gordon, that they tie together the moral rot in the monetary state and also in the markets in a way that I've never seen anyone else manage. And so I think I really appreciate that you've prepared those charts and that you've described for our listeners and your readers how the moral and ethical rot of deception and manipulation and bogus statistics and so on that we've covered before, how it ties into and creates marginal return. And what marginal return is, it's also called diminishing returns. And that's where you have to put more and more capital and inputs to keep the same yield that you had before. Or you put the same amount of capital and labor into something and the yield declines. And so that's diminishing returns. And a common example is back in the good old days when you could poke a hole in the ground and oil would gush out, it was under pressure, then you only had to invest 1 barrel of oil to extract and refine, let's say, 50 barrels of fuels from that oil. Well, in today's unconventional oil fields, such as shale oil, then you've got to invest 1 barrel of oil to get out 3 barrels of refined fuels. And so you can see that the return on that investment of 1 barrel of oil has dramatically declined. And so what we're dealing with here is we're dealing with resource depletion. We're dealing with, as you call it, monetary malpractice. The moral hazards have led to a declining return on so many.
Charles, the return is a perfect example with your barrel of oil is in the whole finance industry. This is called gearing or leverage. And so it used to be, you were 10 or 15 to 1 to get your kind of profit. Now you have to run 40 and 50 to 1. That you have to leverage up or gear up, whether you're a company, whether you're a bank, because the returns are so small and so narrow. So the only way that you can get a satisfactory 6 or 7 or 8% is to take on the amount of leverage. And that leverage comes with ungodly amounts of risk. And what happens is one slight mistake when you're at 50 to 1, a 2% loss means you're upside down on a 50 to 1 kind of leverage. You lose 10%, you're insolvent immediately. And I'm not talking about just governments. I'm talking about corporations. I'm talking about individuals. This is why we've had marginal returns, is because of the risk equation. We've lost touch with the reality of risk.
Excellent point. Okay, our next slide shows what you were just discussing, that when you use debt and leverage to try to maintain a yield, eventually you get a debt saturation point where the more you borrow, you're not getting any yield at all. Your yield is now negative. And that's where we are in the U.S. economy.
This says stimulus spending doesn't work, doesn't it?
Yeah, that's right.
We spend money, we print it to get growth. It says you're losing, the money's gone. Whereas before, $1 worth of stimulus spending would get us $2 or $3 worth of growth, at least short term. May not be long term, but short term. Now it says you're not going to get it. That's a major difference in the whole Keynesian structure that's now collapsed.
Yes.
And I don't believe a Keynesian out there will acknowledge it, but it's the truth.
Yeah. Well, the Keynesians they're incapable of differentiating between a malinvestment and a good investment, because once you just flood the market with money and speculative bets are encouraged, then of course malinvestment makes more sense, if you will, than a prudent investment.
They confuse wealth with money. Money is not wealth. It can only be wealth if it's a store of value. And that's a huge difference. And so when you print money, you destroy the store of value in it. So it's no longer wealth. And by the way, money's only a claim. They're playing all sorts of games. And this chart that you brought with you, Charles, really shows why it's broken. And that, in fact, we have debt saturation today and what it means.
And the next slide shows that the federal government, since the global crisis, financial crisis began in 2008, has borrowed and spent, or squandered, if you will, over $6 trillion. And this was to prop up the status quo and restart the economy and all that. Well, you can see from the adjusted gross domestic product, the GDP, it went nowhere. It actually showed a small decline from 2008 to like 2011. All that money bought nothing in terms of GDP. We didn't get any growth. All we did was maintain bloated, risky malinvestments.
Some people got rich on this, though, Charles.
Yeah, that's true.
So I'll leave that for another show. I think we had one on crony capitalism, but anyway.
Yes. The next slide, again, is another example of diminishing returns. The federal government and the Federal Reserve have poured trillions of dollars into the housing market with backstops, guarantees, purchases of impaired mortgage-backed securities, on and on. Guaranteed loans, 3% FHA loans. They've poured trillions into kind of trying to reflate the housing market. And as this chart shows, it's accomplished nothing. I mean, all they've done is stabilize the housing market at a much lower level. And so then the question is, well, what happens when they stop putting trillions in to support the housing market? How low will the next leg be?
About 30% lower.
Yeah. And I mean, I'm laughing because no one else has the courage or, to say that.
Not with my money. You see, the difference is I'm not on the sell side. I'm on the buy side. So the sell side analyst would tell you, oh, no, it's at the bottom. And I know I just saw the new home sales numbers come out and they were raving about them. And I go, yeah, but prices plummeted. I don't get it. But we can, I guess we're so, it's what we started with. We're so into spinning misinformation, distortions, that we've lost touch with reality. I mean, it's just common sense. We were talking in our previous show about household formations, Charles, and what's going on with students, and the fact they're moving home. I mean, they're not going to be buying houses. Yet we're talking about housing being at a bottom and wanting to pump more money into it.
Yeah, and as the next slide shows, look at how many people are underwater. In other words, so you've lost the middle of people that thought they were going to have home equity, and in fact they're sitting on a mortgage that's worth that's higher than their home value. So they've got no home equity. And then you've got the younger generation without the income to buy housing. Well, that's a double whammy. How does anybody think housing's going to recover when there's millions of people with zero equity and millions of people without the income to get in on the first rung of that ladder?
Charles, what we have is insolvency running rampant, and that is where, in fact, the assets are not large enough to support the liabilities. And so what typically happens, this is not uncommon in all these examples, and therefore what you do is you put something into bankruptcy. You call timeout and you say, look, it can't meet it. You go into bankruptcy, you reallocate the resources, you sell it off, you break it down, you liquidify, you get rid of the debts. It moves from weak hands to strong hands because there's players out there that maybe a smaller bank that can now take over something that was considered larger. But what we've done is, when was the last time you saw a bankruptcy? With the amount of mispricing and malinvestments that we're now seeing, we should have massive bankruptcies going on, but we can't afford a bankruptcies because we found with Lehman, any bankruptcy will bring the house of cards down because of the cascading effect of how collateral is now being hyphenated across our entire credit system. So any small bankruptcy is such a big deal, and that's why even in housing, why we'll let people stay in houses rather than throw them out, sell the houses at a cheap. But banks can't afford the write-downs. So we fictional games of mark-to-market, our commercial real estate's overstated. So this whole game of extend and pretend, kick the can down the road, fake it till you make it, has distorted asset prices. And at the same time, this game of off-balance sheet contingent liabilities have distorted and hidden liabilities, and therefore we've got excessive gearing. This is not complex, but we don't want to face it. And our powers to be, our regulatories, are giving so much forbearance. And until we finally face that day, and it's going to come, because no matter how you jury rig a P&L, no matter how you jury rig off balance sheet, the day it comes is in cash flow. You get non-performing loans, cash flow doesn't come in, and you can't get the cash because your collateral won't get you a short-term loan. And by the way, that's what's going on in Europe right now. Because they got a collateral problem. There's not enough collateral that people believe in that they will accept for a loan. And as they're rolling. So our listeners need to understand, don't let anybody tell you this is a complex problem. We just don't want to face it globally. And the politicians don't want to face it at all.
I think that, Gordon, your phrase "insolvency is rampant" is just summarizes it beautifully. And I want to remind our listeners that if they go back to our March and April shows, we talked about financialization, which was the gutting of the real economy, the let's pretend economy, which, as you said, was all about phantom assets acting as collateral, and fake wealth. And so all those people that have their house, the bank might say the house is worth $400,000, but it's really only worth $250,000, and so, as you say, our whole economy is insolvent because the collateral is phantom. It simply is not real.
We have collateral contagion going on because nobody can post it in, because we don't have effectively mark to market. And so you go in, but anybody who knows what's going on says, that collateral's worth 40 cents on the dollar. I don't care what you got it on the books. I don't care that the regulators are allowing you to keep it on the book. I'm not going to fund it. It's like you funding somebody's house that was originally $600,000, and now you're going to pay them. You're going to take over the mortgage from the person. You're going to say it's only worth $200,000. I don't care what somebody's telling you it's worth, because you're not going to take the risk when it comes due with the rollover. And that's what we have now. We have the mother of all rollovers now occurring in the financial markets around the world. And in 2013 it hits.
You're absolutely right.
And we will attempt to paper it over again, Charles. Don't anybody think that therefore it's the end of the road there. It's the papering over that will cause the real problems again, because there's going to be a complete disbelief in the currencies. And when you get hyperinflation, when you don't get hyperinflation because of just rising costs and inflation. You get hyperinflation because nobody believes in the currency. It's a flea from the currency that causes it. And that's the crisis that will evolve sometime in 2013.
I think that extending what you just said, I think when we look at, say, healthcare, which is almost 20% of the U.S. economy, we also have that same crisis of legitimacy, if you will, that speaks to another show we did this year on crony capitalism, that you go, why does the U.S. spend twice as much per person? And yet we have millions of people who are uninsured. Our health by any metric is actually lower than other countries. How do we get less health, though we're spending twice as much? And then the answer, of course, is a diminishing return created by crony capitalism, cartels that skim off the money, just outright fraud that it eats up roughly 40% of all the money we spend. Useless paperwork. I mean, on and on. We all know that the system is broken, and that our competitors, our high-cost competitors, France and Germany, they spend half of what we do, and Japan spends roughly a third. So we're not going to survive in a global economy if we're this uncompetitive. And that's the result of the forces we're talking about. Diminishing return. We just throw more and more money at these problems as the yield, as the return on our investment declines. That's a path to total destruction.
It's all malinvestment is what it is.
That's right.
Mispricing and malinvestment.
Yes.
And if you're an Austrian, you know that when you debase the currency and you lose its store of value, it's only a matter of time. Once you enter that road, it's irretractable, and it will escalate and will accelerate. And that's why these roadmaps that I show are so predictable. It's not complex. It's human nature. It's a natural sequence of how we will react, and it's behavioral economics applied to the modern situation. And I'm sure in Washington we have many, many economists that understand this in spades, but it's not politically time to tell the public this. It'll take a market clearing event on a crisis of substantial proportions for change to happen, because the change, Charles, goes back to some of the other shows we've talked about. It's going to involve a major readjustment of our standard of living. It's already happening at a lower standard. But the labor arbitrage in the world says that the United States and the developed countries cannot maintain the current standard of living that it has. And the governments are trying to buy time to lower ours as others raise, so we'll come up with a correct balance. But the imbalance is so large that it's structurally tearing our system apart. And we keep and a dam keeps leaking and cracking, and we keep plastering it, but the dam is huge, and it's going to break. And we have a system that was never designed, Charles, as an old engineer, we used to stress test things until they broke. Well, we didn't stress test our financial system. Every time it breaks, we patch it and away we go. But right now we've got so many things like a $600 trillion swaps market running totally unregulated, unpoliced, off balance sheet. Just as one example of many, this says, where was the testing in it? And if it starts to collapse, nobody has a clue what'll take over. So we've built a structural edifice, a structure that nobody actually has control over, and nobody knows what happens when it's breaking. They're just afraid it's going to break. And Lehman was a good example of the damage that it undid. And can you imagine if we started getting 10 or 15 of those happening? And that's what is in store, Charles.
Yeah, the dominoes are going to fall.
But we can stop it if we would just realize that we've got to follow this, like the banks, too big to fail. And it's really too big to exist. We should have taken these banks, broke them apart, put them into debtor in possession with the government, restructured them, and moved on, written off these kinds of debts that they've got. Some of these countries need to write off these debts, but the banks and the secure holders, bondholders, are refusing and have enough power and enough clout that they believe that all of these malinvestments can be passed off to the taxpayer, and that we'll absorb it. And that's what's happening. We're absorbing it one after the other, except it doesn't work. There's $30 trillion that needs to be written off, minimally, according to my calculations, Charles, and there's not enough tax money to support it.
Well, I think the next slide speaks to what you just alluded to, which is the global nature of this problem.
And it is global, clearly.
Yeah, and as you say, I mean, there's write-offs that need to be taken in the trillions of dollars everywhere. This particular slide is just one illustration of that phenomenon that we're discussing. This is the cost in household income for housing, around the world. And the lowest down there is Singapore and Toronto and Los Angeles, believe it or not. Although you wouldn't believe that if you lived in New York or Los Angeles. It seems like housing's very costly. Then you go up to the top and you see it's Shanghai and Beijing. A lot of people, if you visit those cities, which I have visited Shanghai a number of times, and it looks very prosperous and everybody seems to be wealthy and so on and so forth, you forget that the average urban income for a Chinese worker is about $3,300 US, or 21,000 RMB. And yet the condos or the apartments, the flats there are selling for, 500,000-600,000 US. In other words, the inequality that we spoke about in the first show it's just so visible in this kind of thing, and as is the marginal return. In other words, the diminishing return on investing in housing in China is just so blatant. And you go, these houses are completely out of touch with the income levels. And I think that you could say that about Greece or entire nations, that their national income is completely unconnected to the amount of debt that they're supposed to be servicing. It's insolvency, as you said. It's insolvency is rampant.
We all know the bigger problem right now is confuse liquidity with solvency. And the Federal Reserve, and that's why I called the opening slide Monetary Malpractice, is if the only tool you got is a hammer, everything looks like a nail. So we're trying to solve all of our problems, current problems that are structural, by in fact using monetary or increasing the amount of liquidity. And all it's doing is it's completely distorting and making the system even more dysfunctional. We've lost, as your opening chart shows, that the stimulus spending no longer works. Because too much debt that has to be supported. Matter of fact, the stimulus spending, Charles, is actually in many cases going to support the existing debt. That's effectively what's going on. It's going roundabout back to the banks to pay for I'll use the word the fig. Some other people would use a different terminology, but I like to call it the fig. I guess we are out of time as usual. There's so much to talk about, Charles, and I really enjoy our conversations. And I love your work. The articles that you do are right on, and I look forward to every one. And it really brings out the kinds of changes that very few people are writing about and very, very few people are talking about. So I really compliment you. Any last comments that you'd like to make here as we wrap?
Only that I appreciate your invitation and to speak about these issues, and I would put you in that same small circle of people who understand that there's a moral, ethical, and cultural aspect or manifestation of the kind of financial rot that we are living through.
We clearly are, but Charles, I really need to stress to our listeners, this is not all doom and gloom. This is a natural state of progression of mankind where, you had 2 steps forward, 1 step backwards. It's the only way we grow, we learn, we improve. I believe the future for the world is unbelievably positive, where we're going to have standards of living that are much higher for all 8 billion people, not just 2 billion in the developed world. And the changes that we're seeing around the globe on a daily basis are truly stunning. So I'm very, very optimistic. But I need to say, in the next 10 years, we're going to go through an extremely difficult time. But we're going to come out of it if we learn the lessons and we pay attention. And we will come out in better shape, because it's in our DNA to keep growing and to keep progressing. And we will learn. We will learn from this. But unfortunately, what bothers me the most, Charles, these are all lessons that have been learned by our forefathers. Everything we're talking about, we're just repeating it. And our politicians right now I think they need to be sent back to school to take some history lessons and to learn. Anyway, with that, we need to break, so I'm looking forward to having you back next month. I'm looking forward to talking about some more of your work that you have. Can you give us any insights, Charles, as we close, just on what you're planning on writing about over the next month?
I would say that I would continue discussing the crisis of legitimacy, which is another way of describing these issues of social unrest and diminishing returns, that eventually people will lose faith in the system. And only then will we get the positive change that you referred to.
That's exactly it. When we lose faith in one system, we will design a system we'll have confidence in. And that's where my optimism stems from. Talk to you next month.
Okay. Thank you so much, Gordon.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.